A warm welcome, friends, to this new chapter called Understanding Balance Sheets. It is part of many finance curriculums and especially it is part of CFA Level 1 Financial Statement Analysis. So, a balance sheet has many bifurcations in terms of parts. So, we will look at all these bifurcations, all these divisions, what they mean, and how do we record them and how do we account for them. So starting with the first thing, let's look at a balance sheet first. So here we have the balance sheet of 2024 for TCS. You can see here, friends, there is something called asset. Under it, the main two subdivisions are non-current assets and current assets. Then you add them up to get the total assets, right? The total assets here. Now after this, we have equity and liabilities. So we have equity here mentioned, and after that you have liabilities. And like assets, under liabilities, there are two kinds of liabilities, which are non-current liabilities and current liabilities. And there are several bifurcations of non-current and current liabilities thereafter. So we will try to delve deep into the subdivisions of all these terms. For now, we'll start with the overview. So if we have to start with the overview, what better thing to start than assets? So friends, let us try to define assets. Assets are basically what is controlled by the owner, what is owned or controlled by the owner. And this is an accumulation as a result of past activities, and this is going to be the reason, ideally, this is going to be the reason for future inflow of incomes. So let us define it. So assets are what is controlled or owned by the owner, that which is a result of past activities, and ideally, that which is the source of future inflows. Liabilities is more like an opposite or antithesis of assets. So liabilities are basically what is owed by the owner to others, and which is also a result of past activities, and under certain ideal circumstances or under the defined circumstances, they can be the source of future outflows. So liabilities are that which is owed by the owner to others, other entities, that which is a result of past activities, and likely that which is going to be a source of future outflows of income or outflows of cash. Now comes equity. Equity is basically the residual of assets after taking out the liabilities. So equity is the residual of assets after taking out the liabilities. So basically, equity is equal to assets minus liabilities. This implies assets is equal to equity plus liabilities. Now this is the main source of the balancing. So on one side you have assets, and on the other side you have equity and you have liabilities, both exactly matching each other, because equity is basically nothing but A minus L. You take out the liabilities out of the assets, whatever remains you put in equity, and you balance both sides. This is how balance sheet is constructed. Although in our example, what we are seeing is they are written they're stacked one above the other, but the numbers will be exactly the same. If you do equity plus liabilities, you will find that it is coming exactly equal to assets. Let's verify. See here, friends, total assets 121,148. Total equity plus liabilities 121,148. Previous year 119,827. Total assets previous year 119,827. So it is the balance sheet that we are talking about here also, naturally. So friends, when we are writing the balance sheet, it cannot be that we haphazardly write any item anywhere. There are several items that can be defined within the balance sheet, as a part of the balance sheet. So it's not like that you can write anything anywhere and get away with it. It has to be organized in a certain way. So one of the ways to organize the different items under assets, equities and liabilities is basically assessing the nearness to cash. Nearness to cash means we can call it kind of liquidity. Nearness to cash. For example, cash. So it is very much liquid. Then comes marketable securities. Marketable securities. They are also immensely liquid, but they may be overnight, they may be 3 months maturity, they may be 7 days maturity, like that. So they are a little bit away from being instantly liquid. They are not instantly liquid. Then another example can be property, plant and equipment. Property, plant and equipment. Let's say you have a plant of 1000 acres or 10,000 acres. Now you want to liquidate it. How much time should it take? What do you think? It can even take years. So this is far away from cash. This is far away from being liquid. So a basic premise that we use when we are categorizing different items is basically whether they are instantly liquid or instantly liquidable or not. Herein comes the definitions of current and non-current. So anything that is liquidable or going to be liquidated, that is converted into cash within 1 year, or one operating cycle, that is current item. Anything that takes more than this time, that is more than 1 year or more than one operating cycle, is non-current item. Examples of current items, obviously cash, marketable securities, receivables, inventory. Examples of non-current items, property, plant and equipments, debt held to maturity, intangible assets, etc., etc. Now, what is an operating cycle, friends? An operating cycle is basically the time it requires for cash to be invested in the business and for it to come back as cash. So you have put in cash in the business, what time it takes, the minimum time it takes for that cash to return back as cash is called operating cycle, one single operating cycle. So how does this work? Let us look at it a little bit more. You enter cash and you take in raw materials, right? You take in raw materials as inventory, then you create a product, then you sell it. When you sell it, you get the revenue. This revenue is basically coming back of your cash as cash. So this is the entire operating cycle. How much time it takes, that is defined as operating cycle. Generally, for current and non-current definitions, we use 1 year only. That is considered as the standard, but sometimes operating cycle can also be used. IFRS and US GAAP requirements in terms of describing or drawing up or drafting up a balance sheet. Both of them require bifurcation of current and non-current, both in terms of assets and liabilities. Now there is an exception in IFRS to this. IFRS says that if the balance sheet is able to explain its item in a more reliable and more organized way than the current non-current bifurcation, then it can use those other means. One example can be liquidity based arrangement, where the balance sheet might start with cash, then go into more and more or less and less liquid items like marketable securities, then to receivables, like that. They arrange it in terms of nearness to cash or distance from cash. That can be one way of representation. Now coming to current assets and non-current assets. Obviously, assets which have to be liquidated within 1 year or one operating cycle are called current assets, and those which will take more time than 1 year or one operating cycle to be exhausted or liquidated, they are called non-current assets. Examples of current assets: receivables, cash, inventory. Examples of non-current assets: property, plant and equipments, intangible assets, etc., etc. Current liabilities, non-current liabilities. Again, here also the same definition applies. We are going to take a few examples also here. So liabilities that have to be fulfilled within 1 year or one operating cycle, they are called current liabilities. And those liabilities which run for more than 1 year or more than one operating cycle, they are called non-current liabilities. Perhaps a company has taken a 7-year loan. It has given 7-year bonds out, issued 7-year bonds. That is a non-current liability. Current liability: I'm taking 7-year bonds. It can be a 10-year bond, it can be a 5-year bond, like that. Current liabilities, for example, supplier's credit or trade payables. They are generally within 1 year you have to fulfill them. You have to return it back. Notes. You may have taken short-term debt that have to be liquidated back, or that has to be paid back within 1 year. Notes payable. These are examples of short-term debt or current liabilities. 5-year bond, 10-year bond, 7-year bonds, or 5-year debt taken from a bank, that is also a non-current asset. A balance sheet which is bifurcated in terms of current and non-current. So let's say there is assets and there is liability plus equity. You have a mention of current assets, non-current assets, and you have a mention of equity, and then current liabilities, non-current liabilities. This current and non-current mention, if it is there in a balance sheet, it is called a classified balance sheet. Working capital. Working capital can be simply defined as the difference between current assets and current liabilities. Previously we understood what is equity, friends. Equity is total assets minus total liabilities, right? Similarly, working capital is current assets minus current liabilities. This is working capital. Liquidity based presentation. This is an alternative to the classified presentation, friends. So what this does is basically it sequences the assets. It does not mention two different classifications, right? Current asset and non-current asset. What it does is it starts with cash and then goes on in terms of reduced liquidity, and like that it goes on. For example, marketable security, then in receivables, then inventory, then getting into the fixed assets, maybe some other assets, and then maybe into goodwill or intangible assets, like that. But generally a non-financial company does not use this format. This format is generally used by a bank where the inventories and these things are not there. Inventories and receivables, these things are not there. It's mainly cash and starts with cash and then ends with goodwill and intangible assets generally. So that kind of representation happens. So friends, here I have the balance sheet for HSBC Bank. You can see here there is a single mention of assets: cash, trading assets, financial assets, derivatives, loans and advances to banks, loans and advances to customers, reverse repurchase agreements, non-trading, financial investments, assets held for sale, and other assets. There is no mention of current or non-current assets. So this is an ideal example of liquidity based representation. Even in case of liabilities, you can see deposits by the banks, customer accounts, repurchase agreements, trading liabilities, financial liabilities designated at fair values, derivatives, debt securities in issue, insurance contract liabilities, liabilities of this is basically we start with the most liquid and then go on in terms of reduced liquidity gradually, and that is the way both assets and liabilities have been arranged, right? So this is an ideal example of liquidity based balance sheet presentation. Cash and cash equivalents. So cash and cash equivalents are basically financial assets with the highest amount of liquidity. Financial assets with the highest amount of liquidity. Now, being financial assets, they are either recorded in amortized cost, or fair value. Fair value means price at exit. Now, to understand what stands for cash equivalents, cash we understand already. What stands for cash equivalents, we take a few examples. So, examples of cash equivalents are treasury notes, money market funds, commercial papers, etc., etc. They are generally within a maturity of 3 months. These are cash equivalents. They are so close to maturity, basically the amortized cost or the fair value do not fluctuate much. They do not make much of a difference. Even if interest rate, their risk to interest rate changes is basically next to nil. So this is what cash equivalents are. And cash obviously is cash. Marketable securities. These are treasury bills, notes, and equity instruments like stocks, like mutual funds, like ETFs. Basically, these are securities that can be bought and sold in open market. That is, there is a market for it, where they can be bought and sold. So they are highly liquid. Receivables. Receivables are basically you have made the sales, but the cash is yet not received. This is basically what is receivables. Now, there is something called gross receivables and there is something called net receivables. Net receivables is basically gross receivables adjusted for doubtful accounts or uncollectible accounts. Now, this adjustment, this doubtful account or uncollectible account is basically called a contra account. Contra account. This is created as a contrary to receivables so that this works as an adjustment and gives us a net realizable value. This gives us a net realizable value. Now, a few things are very important to note, friends. For example, the doubtful accounts, the value of them should not be fluctuating too much. They should be stable as a percentage of the gross receivables. If that percentage is very volatile, you must understand there is something wrong going on, at least temporarily, if not permanently. Then there is something called receivables to sales ratio. This should not trend upwards. It should not trend upwards. If gradually the receivables is increasing as a proportion of sales, there must be something wrong with the credit policy. Some sales are being pushed unnecessarily to show high figures of revenues. Maybe. It may be. So these are two factors that you have to recognize. Then the third thing is concentration of clients. Concentration of clients. High concentration of clients means high concentration of credit risk. So if there are 3 customers only and they give you equal chunk of your revenues, then if one of them fails, that means 33% of your revenues are gone. So client concentration is a very important thing that one has to check in terms of assessing the probability of return of revenues and what percentage loss is probable. Now we come to inventories. So friends, Inventory is having different standards with respect to IFRS and US GAAP. Let us consider them separately, therefore. So, for example, under both IFRS and US GAAP, inventory is valued at lower of cost or net realizable value when the method of inventory collection is not LIFO. So, inventory record is lower of cost or net realizable value, provided that it is not LIFO method is not being applied for inventory liquidation. Now, what is net realizable value, friends? Net realizable value is selling price minus cost to sale minus fulfillment expenses like completion expenses. This is the net realizable value. This or the cost, whichever is lower, is basically the recorded value at the inventory line item. This is for both IFRS and US GAAP. US GAAP, there is one provision here. When there is LIFO method being used, the option is either cost or market value. Market value is defined as current replacement cost. So, lower of cost or market value is going to be the value of the inventory. LIFO is not allowed in IFRS. It is allowed in US GAAP. Now, let's say the carrying value of the inventory has become greater than the realizable value at a certain point of time. This will necessitate write down. Write down means you reduce the carrying value to the right value where it is fair, the amount is fairly reflected. Now, this write down can be reversed if the valuation again is increased. This can happen under IFRS. But this reversal cannot happen in US GAAP. Once you have put it down, once you have written it down, you cannot reverse that write down. Not allowed. The inventory methods used under IFRS are FIFO, weighted average costs, and specific identification method. Right? LIFO is not allowed. Under US GAAP, LIFO is allowed. So here you can do FIFO, you can do LIFO, you can do SIM, you can do WAC. So that's all about inventories. Other current assets. Other current assets are basically those items which do not entail separate line item mention. So they are like miscellaneous assets. So one example for this can be prepaid expenses. Let's say you have next 12 months monthly premiums to pay for an insurance. Right? What you do is, this starts from January. What you do is 31st of December, you pay the entire thing. You make the entire payment. Now this becomes an asset, and that asset can be called a prepaid insurance expense, because the payment time or the payment schedule has not yet begun. It is going to begin from the next year, but you have already paid for it. So you create an asset against it. And as the premium timings come due, you reduce from the asset the premium amount accordingly. So that's how other current assets function. There can be various other miscellaneous current assets which do not entail separate line item mention. They all are under the other current assets umbrella. Now we come to current liabilities. Current liabilities are basically those liabilities which have a period or a exhaustion period of less than 1 year or less than one operating cycle. Within that, they have to be liquidated or they have to be paid off. So the examples for it or the items under it are trade payables, accrued expense, deferred income or unearned revenue. Let's look at each of them. Trade payables are basically supplier's credit. You have taken up material, you have taken them up in credit, and you have to pay them maybe in 30 days, 40 days, 3 months, whatever. It is usually and mostly within 1 year you have to pay back. These are trade payables. Then there is accrued expenses. Accrued expenses means expenses that were due in previous terms that you did not pay off. For example, it can be employee arrears. So previous year expenses on employees which you have not incurred, you are going to incur within 1 year period of this year. That is one example. Then it can be deferred taxes. Other examples can be accrued interest payments, accrued warranty costs. So warranties have been claimed but you have not fulfilled them on time. This can be a liability for you, that is accrued warranty costs. So these are certain examples of accrued expenses. Then comes deferred income or unearned revenue. Let's say you have signed a service agreement for your equipment. You have sold an equipment and you have signed a service agreement for the next 5 years. And you have taken the payment right now. This can lead to an unearned revenue because the timings are still there in 5 years, distributed over 5 years, but you have taken the entire payment of the agreement right now. So this will create a liability, a current liability in the form of unearned revenue. Unearned revenue, another example can be someone has subscribed. Let's say you are a domain and hosting seller company. You have sold a domain for 5 years and you have taken the entire payment right now. This can also be an unearned revenue or a subscription for multiple periods, or for one period, whatever the subscription amount is, you have taken in the beginning the entire amount. That also can be an unearned revenue. Another example is, let's say technically your revenue recognition starts when delivery happens. Now, some customer has paid you before the delivery. Okay, delivery means the item has been dispatched from your plant or distribution or dealer or whatever, but the payment has come before the dispatch. That will also become an unearned revenue. So these are some examples of deferred income, and we are through with trade payables, accrued expense and deferred income or unearned revenue. Next we'll move on. So friends, we'll talk about non-current assets. Non-current assets are basically assets that are going to last more than 1 year or one operating cycle. Right. Ideal examples for this are property, plant, equipments, land, office building, etc., etc. Now the first item in non-current assets that we are going to talk about is property, plant and equipments. So property, plant and equipments are basically reported in two ways. One is the cost model. Another is the revaluation model. The cost model is basically, let's say a property has a useful life of 15 years, right? From here to here there are 15 years. Let's say we are using the cost model at this point. This is going to be historical cost incurred at this point at the beginning minus the accumulated depreciation over this period. Okay, this is going to be the cost model. Difference between cost model and revaluation is basically this. Here in case of revaluation model, what happens is, let's say the same property is being valued under revaluation model. What will happen is, if you are valuing it at this point, the measurement will be fair value at this point. This is at time t minus accumulated depreciation. Minus accumulated depreciation. So this is the difference. Now one more difference is, this is allowed only under IFRS. This is not allowed by US GAAP. On the other hand, cost model is allowed both under IFRS and US GAAP. In fact, US GAAP allows only this form of reporting for property, plant and equipment. Now, this kind of valuation is a gradual valuation. We have a carrying value at the end of the valuation, right? Now, sometimes it may so happen that a portion or the whole of a property or a plant or something loses its value. In that case, whatever the carrying value is there, we have measured it in various ways, maybe revaluation, maybe cost model, that is not relevant. We have to, in this case, when the value has been suddenly reduced in an unanticipated way, then what we do is, we do revaluation of it. We do an impairment calculation of it. And impairment calculation basically is defined in the following way. It is the recoverable amount. Recoverable amount can be defined in two ways. One is fair value minus selling cost, and the second is value under usage. This is basically when you are trying to sell it directly, you don't want to keep it with you. Whatever selling cost you require, you subtract from the fair value when you sell it, and that net value is the recoverable amount. The value under use is basically, if you keep the asset, then whatever future cash flows you are going to gain from it, it is the present value of future cash flows. Basically the sum of the present values of the future cash flows. So after both these values are calculated, the higher of the two is taken as the recoverable amount. And once impairment happens, reversal is allowed under IFRS. Reversal allowed under IFRS, but not allowed under US GAAP. So you have to remember this. Reversal of impaired value is not allowed under US GAAP. Investment property. What do we mean by that? Friends, in companies, majority of the assets are basically used to produce the end product or the service that the business's regular activities are. But there are certain assets or certain properties which provide only two things: rentals, rental income, and capital appreciation. Basically, these two are the only purposes for a property of that kind, apart from regular activity properties. So these kind of properties are basically called investment property. Now, this term investment property is used specifically in IFRS. US GAAP does not have any specific definition for investment properties. Now, IFRS allows two kinds of reporting format for this. One is a cost model. Cost model means historical cost minus any accumulated depreciation. And there is a second method which is called the fair value model. Under fair value, it is revalued from time to time and the change to the current fair value. And whatever gains or losses happen, these two are transferred or mentioned in the profit and loss statement. They basically, if a gain happens, that enhances the net income, and if a loss happens, it reduces the net income. Companies that own investment properties mainly are property management companies and sometimes endowment trusts and insurance companies. These two entities may also hold investment property kind of properties. Intangible assets. So friends, intangible assets are basically assets that cannot be physically identified. those assets which cannot be physically identified, but they clearly work as assets for the company. These can be stuff like trademarks, licenses, patents, trade secrets, etc. Now, a company may internally develop some intangible asset which is not at all recognized in the balance sheet. For example, a brand name, recall, a good reputation. These are basically these things basically intersect in terms of meaning. Good reputation, highly trained workers, or highly developed training systems basically. So these kind of things a company may develop, and if it is internally developed, it never gets mentioned in the balance sheet as an asset, but it is an asset. Now when acquisition happens, the acquiring company has to recognize something called a goodwill. This is basically the extra amount that the company has to pay other than for the physically identifiable assets because of intangible assets like brand name, like brand recall, like a good reputation, like highly developed internal systems, etc., etc. So when it is internally developed, there is no such thing as goodwill to be mentioned. But when you are acquiring a company which has these kind of extra advantages, you may have to pay for it. And when you pay for it, and that amount is not covered under the physically identifiable asset amounts, you create a separate asset which is called goodwill. How is intangible asset reported? So under IFRS, it is reported under cost model or revaluation model, right? Revaluation model or cost model. We already know what is cost model. It is historical cost minus accumulated depreciation and amortization. In case of intangible assets, it's basically called amortization. Revaluation means when you are revaluing it, you detect the fair value of it and you reduce any accumulated amortization. US GAAP does not allow revaluation model. It only allows cost model. Now, intangible assets can be of two kinds. One is of finite life. Let's say a medicine license. Let's say a company which makes specialized medicines has a license for medicine that may last for say 20 years. So this intangible asset has been created for 20 years. After 20 years, this will expire. This kind of an asset is eligible both for consideration of amortization, and also it can be considered for impairment, right? Let's say the medicine later on the regulators found that it has certain downsides, so that license becomes impaired. That can happen. While nothing of this kind was happening, the regular amortization method was being applied. Now there is another kind of intangible asset which has indefinite life, like a brand name, like a Coca-Cola's brand name, or like a Cadbury's brand name, or like a Britannia's brand name, or like an Apple. So these kind of things, really you cannot give it a number that these many years this intangible asset will last. So in this case, what you do is you look for impairment. Now when there is tangible sign for impairment, then you reduce the value of the asset, either partially or completely. And reversal is only allowed under IFRS. It is not allowed under US GAAP. So things are pretty similar like property, plant and equipment treatments, right? Goodwill. We discussed it earlier, friends. Goodwill is defined as acquisition cost minus fair value of net identifiable assets. Now, what is net identifiable assets, friends? Net identifiable assets is equal to fair value of assets minus fair value of liabilities minus fair value of contingent liabilities. This is basically the fair value of net identifiable assets. Now, goodwill is not amortized. It is checked for impairment. Sometimes it may so happen that the acquisition cost is less than fair value of net identifiable assets. In that case, what happens, friends? Basically, the difference is adjusted in the profit and loss statement. Adjusted in the profit and loss statement as a gain for the acquirer. And this kind of a purchase is called a bargain purchase. So friends, now we discuss financial assets. Under IFRS, financial instrument is that instrument which creates a financial asset for one entity, and at the same time it creates either a financial liability or a financial equity for another entity. So this is how financial instruments are defined. Now, how do we report them? So there are three modes under which financial assets can be categorized. One is fair value through other comprehensive income. One is fair value through profit and loss. Another is amortized cost. Now, what kind of financial assets fall in which category? Let's see. So, fair value through other comprehensive income. In this, available for sale debt securities are definitely there. This is under US GAAP. US GAAP allows this, but it does not allow any equity to be in this category, fair value through other comprehensive income. Under IFRS, certain equity instruments can be included in this category if at the initiation or at the time of acquisition they are categorized in this category in an irrevocable manner. This is an irrevocable classification. Again, under IFRS, any debt security that has been declared as, again under IFRS, any debt security that can be used for both selling, that is capital gains, and for interest income. This kind of a debt security can be put into fair value under other comprehensive income. Fair value through profit and loss. Under US GAAP, any equity, unless that equity which gives the equity owner significant influence, any kind of equity other than that can be included in fair value through profit and loss. This is one category. Again, under US GAAP, any debt security designated as trading securities. That means even interest income is not the main focus here. It is basically selling and gaining from that sale. That kind of debt security is under US GAAP. Amortized cost. Under this category, any debt instrument that is held till maturity or categorized as held till maturity is going to be under amortized cost model. Then any unquoted equity. Unquoted equity. Some equity instruments may so happen that there is not a way you can safely or reliably calculate their fair value. right? Fair value calculation becomes difficult. In that case, cost becomes the main reference point, and that cost is basically recorded. This falls under amortized cost category. Now, fair value through other comprehensive income and amortized cost. Any instrument which is not categorized in IFRS under these two labels can be categorized under fair value through profit and loss, right? Any instrument that has been not classified at the time of acquisition or at the time of initiation under FVOCI or amortized cost can be included in FBPL, that is fair value through profit and loss. This is under IFRS. Deferred taxes. What are they? Let's try to understand, friends. So friends, there are two kinds of income actually. One is taxable income and another is statement income. That is the income which is stated in the financial statement. Now for taxation purposes, certain amounts may be recognized which are not required to be recognized here, right? In that case, what happens is the taxable income becomes greater than the statement income. This results in this kind of a difference, and if you multiply this by the tax rate, we have what we call is deferred tax asset. Also, let me include it here only, the reverse may happen, that taxable income is less than the statement income. In this case, the reverse thing happens. What happens is tax income minus statement income into tax rate. This gives out a deferred tax liability. This may also happen. Other ways of happening. Let's say income is same for both, right? But for taxation purposes, certain expenses are recognized which are less than the expenses in the income statement. So, for taxation purposes, the expenses that are mentioned is less than the statement expenses that are mentioned. This also results in deferred tax assets, provided the income is constant. And the reverse is also true. If the expenses used for taxable reasons is greater than those used in statement, then what will happen is a deferred tax liability will be created. Now in the subsequent terms, when these expenses are balanced, these are basically temporary differences, right? Temporary timing differences. Ultimately, one has to recognize both in both the segments. So when the one which is not recognized is recognized, the asset or the liability gets written off. That's what happens. So you did not mention something in the income statement for which you already paid the tax. Let's say some part of the income. A deferred tax asset is created. But the moment you recognize it here, this portion of the deferred tax asset is written off. Similar for all the cases. Long-term financial liabilities. So these are basically greater than 1 year period liabilities that have been taken up. Let's say a company releases a bond at 7%, trading at 95, that is 5 below par, right? Trading at a discount, that is. This is 7% of par, so there is no problem in this. Now what will happen is, how will the reporting happen? Let's understand. So let's say the duration of the bond or the maturity of the bond is 5 years. So this 100 minus 95, this will be amortized over the period of 5 years. So let's say 5 years, 1, 1, 1, 1, 1. This is the way this will be pulled to par at the end by the maturity. Another example can be a bond is released which is now trading at 105 and there is 5 years left to maturity. In that case, what will happen? It is above So over the period basically it is 105 right now. 100 is here, let's say. It is 105 here. So over the 5 years, this will be pulled to par by reducing 1, 1, 1, 1 like this, right? So this is an easy term, friends. Long-term financial liabilities, nothing much to discuss here other than this. Pretty easy, just like finance. So friends, now we come to the equity. Equity, as we know, is assets minus liability. This is basically when you take out, adjust the assets for the liabilities, what you are left with is the equity. Now, equity can be bifurcated into various sections or categories. The first of these sections that we discuss is contribution from owners. Contribution from owners is basically the shares, the capital contributed by the owners. They are basically expressed in the form of par shares or no par shares. This depends on the regulation, and if you want to define it, par share means there is a value mentioned. Let's say 1 rupee or 10 rupees per share, or 1 paisa per share, or 5 paisa, 10 paisa per share, like that. 5 cents, 10 cents, like that. No par means there is no value attached to it. And this difference depends on the regulation. Now, these shares can be in 3 states. Now, when a company is listed or when a company issues shares, 3 things have to be mentioned or clearly expressed. One is authorized number of shares. One is outstanding number of shares. And third is issued number of shares. Now, to understand all these 3, we also have to understand what is treasury shares. Treasury shares are basically those shares which have been repurchased by the owner. Repurchased by the owner. They are in the balance sheet as equity. These treasury shares do not have any voting rights. No voting rights. And they can be sold back in the market. They can be sold back. When it is sold back, the gains or losses are not adjusted in the profit and loss statement. Please remember this not. If there is a gain through sale of treasury shares, that is not adjusted in the profit and loss statement. Now we come to authorized, outstanding and issued shares. Authorized share is basically the number of shares a company is authorized to issue. Okay. How many? How many in total? This is basically the question. Issued shares is basically out of, let's say, a company is authorized to issue 1 million shares, right? Now, out of that, the company has issued only 0.8 million shares. So this becomes the number of issued shares, 0.8 million shares. Now let's say this has happened over a period of 5 years, right? 5 years. And in these 5 years, in between, this is basically the resultant number of issued shares. But in between, there have been repurchases also. So the company has repurchased and they have made those shares treasury shares. Let's say the company in this 5 years of period has repurchased 0.05 million shares. So outstanding shares will be 0.8 minus 0.05. This is equal to 0.75 million shares. So far 0.8 million shares have been issued. Out of that, 0.05 million have become treasury shares because they have been repurchased in the meantime over these 5 years. Therefore, right now the outstanding shares is 0.75 million. That's how treasury shares, issued number of shares and outstanding shares equate with each other. And these 3 things relate to authorized number of shares in the way that we have just now understood. Now we try to understand what is preference share. Preference share is basically something having a precedential right over common equity. So there is debt, which is basically the first right to income. Debt has the first right to income because net income itself comes after interest is deducted. So debt has the first right. Then comes the right of the preference shares. And then comes the right of common equity. Now the preference shares can be a liability also or an equity also, depending on whatever the conditions are mentioned here. If the preference share has some mandatory periodic income or mandatory exit pricing mentioned, then it becomes a liability instrument. And anything mandatory, maybe some dividend which is mandatory, or maybe some exit price which is mandatory, then it becomes a liability. Otherwise, it remains an equity. In that case also, it has precedence over common equity. Now we come to retained earnings. Friends, net income happens when EBIT has been adjusted for interest and taxes, right? This is net income. Now, when you subtract dividends from net income, what happens is what we call retained earnings. This is added back to the equity component of the company. It is part of the total owner's equity. Accumulated other comprehensive income. So friends, we have already become acquainted with what other comprehensive income is. The accumulated other comprehensive income is basically part of the owner's equity. So other comprehensive income we are already aware of, friends. Any accumulation of other comprehensive income is basically part of the owner's equity. Is part of the owner's equity. Total comprehensive income for a period is net income plus other comprehensive income. Now whatever other comprehensive income keeps on accumulating forms part of the accumulated other comprehensive income. Non-controlling interests. Let's say a company A has a subsidiary S, and it is a subsidiary, but it does not control entire 100% of it. It owns 70% of it, right? It owns 70% of it. And the other 30%, there are other owners for that. Now this 30% is not excluded from the balance sheet of A. This 30% is included. And this 30% is included as minority interest or non-controlling interest. So you are not basically excluding that 30% from your balance sheet. You are including it as part of owner's equity, but it is being mentioned as a separate line item called non-controlling interests. Statement of changes in equity. So friends, under IFRS, the following details about statement of changes in equity are required. Number 1 is total comprehensive income for the period. Number 2 is transactions of owners and distributions to them. So has the owner infused some equity or has some dividends been paid to the owner? This is basically the question. The third is effects of any retrospective changes. So let's say some accounting standards have changed and for that some changes in equity values have happened. Is that the case? That has to be mentioned. And the fourth point is a reconciliation of the components or the value of the equity components at the beginning of the year and the end of the year. A reconciliation of this is required. Coming to US GAAP, they require an analysis of changes of each of the components. That is component of equity. Now we come to common size analysis of balance sheets. Like we saw in revenue that two companies of different scales become difficult to be compared if there is no common denominator used for comparing them. So the same thing may happen here. So let's say one company has a balance sheet like this: assets, equities, liabilities. Let's say $5 billion in assets. This is expressed in millions. $2 billion in equity and $3 billion in liabilities. Another company B has, let's say, $70 million, 70 million, right? Here also it is million, because we are mentioning billions, they are in thousands. The expression is in millions. So this is $70 million in assets, $35 million in equities, and $35 million in liabilities. Now, how do we compare them? What we do is, basically we use a common size method. For doing that, we basically divide each item by the asset of that balance sheet, total asset of that balance sheet, and express the number in percentage form. So what happens is, the converted version is like this. A converted looks like this. Assets 5,000 by 5,000 is 100%. Equity 2,000 by 5,000 is 40%. Liability 3,000 by 5,000 is 60%. And B converted is 70 by 70 is 100%. 35 by 70 is 50%. And 35 by 70 is 50%. Now we are in a position to better compare these two. So this is what the utility of common size analysis is. Balance sheet ratios. So friends, balance sheet ratios help us understand two things pertaining to a company. One is its solvency and other is its liquidity. Now, current ratio, quick ratio and cash ratio, these are basically measurement of liquidity of a company. Liquidity means what? They basically indicate how good a company is or how well positioned a company is to meet its short-term liabilities or short-term requirements, expense requirements basically. So the current ratio, this is basically current assets by current liabilities. If you break it up, this becomes cash plus marketable securities, cash and cash equivalents plus marketable securities plus receivables plus inventory by current liabilities. This is the current ratio. Obviously, you want the number to be high as possible. If the number is less than 1, that means current liabilities are more than current assets, which is not a good sign at all. Then we have the quick ratio. Quick ratio is cash and cash equivalents plus marketable securities plus receivables divided by current liabilities. So we have not used the inventory in this case. So we have made this ratio a little bit more liquidity centric, a little bit more conservative in terms of its measurement or in terms of its ascertainment. Obviously, we want this number also to be high. Cash ratio. Cash ratio is the most conservative among these three. This is cash and cash equivalents plus marketable securities divided by current liabilities. This is basically talking about the cash or very near to cash assets that the company has and how much it is going to sustain in case of some situation. Obviously, we want this number also to be high. So these three are liquidity ratios. After this, we have long-term debt to asset ratio, total debt to asset ratio, debt to equity ratio, and financial leverage. These numbers are more concerned with long-term liabilities of the company. So these are called solvency ratios. Solvency ratios, right? Now, what are the measurements? Let's look at that. Long-term debt to asset ratio, it's very clear, friends. It's non-current liabilities divided by total assets. Obviously, you want this number to be low. Total debt to asset ratio. This is short-term debt plus long-term debt. This has to be interest-bearing, both of them, divided by total assets. Obviously, you want this number also to be low. Debt to equity ratio. This is total debt, which is short-term debt plus long-term debt, both have to be interest-bearing, divided by equity. You want this number also to be low. Financial leverage. This is total assets divided by equity. You want this number to be high, not that high that you do not take advantage of leverage only, but should be in a certain range where this does not become counterproductive. So friends, that's about it for this chapter of balance sheets, understanding balance sheets. We'll meet you in the next chapter. Until then, keep studying and consider subscribing to the YouTube channel. Watch the videos and like and share them and comment on them. Share your feedbacks. And definitely consider joining our CFA Level 1 and Level 2 classes. They are starting in the May month itself. And you will get everything that you need out of it. We will have one-on-one counseling sessions. We'll draft study plans together. We will share the entire curriculum in 4 to 6 months with you, and that will have everything that you need, including all the chapters and their classes. Weekly doubt clearing sessions which will clear all your doubts regarding theory or practice problem or anything. Then there will be practice problems which you will be able to solve. You will have mock exams and all of that. And apart from that, one-on-one consultations will be available at certain regular intervals also, which will be clarifying your doubts further. Till then, keep studying, keep revising your topics, and keep watching the classes. Thank you, friends.